Alright guys, welcome back to WolfPack Cryptos and MMG Invest. In today's video, I will cover TA, technical analysis on the markets. And in a separate video, maybe a few separate videos, because there's just a lot of news, I will cover the fundamentals and some of the news events, recent news events on the stock market, equities, bonds, yield curve, Europe, and their financial sector. But first, I'm just going to cover, we'll just get into it. There's a lot of charts to cover. First of all, this is not financial advice. Consult your financial advisor. I am not your financial advisor. This is more of an educational channel. This is all of my own opinion. I could be wrong. And learn to trade. Do not invest in anything you're not willing to lose. And have your emotions out. Stops in. So, the S&P. Let's go to the S&P. So a month ago, about 2 months ago, I started warning that the top is in for the stock market, the all-time highs, right? And I'm still sticking to that right now. And as every day passes by, it's becoming more obvious for Wall Street and everyone else. Should adjust this triangle. There we go. Alright, so major support, this area right here between 2600 and 2600 and 2650, I would say, about 30. This area was major support for me. Now you can see that we had a few bounces off of it, right? We had the initial first bounce, and MSM, mainstream media, everyone's like, oh, here's the rebound, blah, blah, blah. And I traded both of these bounces, and I took massive profits. It was nice. Those were nice trades. But, and this is a daily chart of the S&P. But, they failed, right? So they pretty much turned into dead cat bounces. This second bounce right here, if it would have surpassed the initial bounce, then you might say, all right, this is probably a rebound. The probabilities would have been higher that it's a rebound, but that failed as well. And today, we are almost testing the lows for the year. Now, or is it for the year? Not for the year. The low for the year was actually at 2,500 pretty much on the S&P 500. But we're getting to the new lows for the past 3 months, for this quarter. All right. And the reason why that is very, very negative for the stock market is because once the support breaks, there's not much more support below it for a while. So if I zoom out, I put an arrow straight down and I put air. And what that means is air. There's no support until we get to, let me bring this on the weekly. And the Dow Jones is going to follow the S&P, so is the NASDAQ and the rest of them. There's a little bit of support around 2,400. There's some support there, but there's no support between it, really. And that's a decent drop from the all-time highs. That's actually a 20% drop. So from the Trump rally, let's do some measurements. So from the Trump rally and the last high in the past few years, That would be a 37% drop if it fell all the way back to the beginning of the Trump rally, right? When Trump got elected, the raging bull market started, right? Now, if we took it to that, let me flip this around here. This doesn't look right. Make it easier on myself. So if the price did break this support today, and today's Monday, the 17th, December 17th, and that support breaks, and then the price will not have support essentially until 2400 on the S&P. What that will give us is a 18% drop, a 20% drop pretty much. Round it, right? 18% is close enough to 20%. And whenever you have a 20% drop from the all-time high, that is historically, that means you are in a bear market, a recession. That's what it indicates, a 20% drop. Some people say once you're past a 15% drop on equities from the all-time high, that indicates it's over. The bear market's here and we're going into recession. All right? And that's why this support area right now that we're sitting on is so crucial, and it cannot break. And we're breaking it. We've already broken it, actually. That's the scary part. That's what's really bad. And I was hoping that this would hold at least for a few more months into the first quarter of 2019, right? I was hoping we would trade sideways in the symmetric triangle for quite some time, at least hopefully till spring, and that would buy us more time. But the market's not that stupid. I mean, this bull market since 2019 was the most hated bull market ever. And it's the longest, well, it's the second longest running bull market in history. It will be the longest bull market ever in, I forgot when, but another year, something like that, and it is the longest. But this is a 10-year bull market. It's really it's an old bull market. So you have the financial cycles. Every 8 to 10 years, you get a recession. So you should be expecting one coming really soon if it hasn't already started. All right, so the Dow looks just like this, the Nasdaq, and all of them. Let's look at some other things. Here's the Dow. The Dow actually looks worse than the S&P, I think. Or no, it doesn't. It's not as bad. But it's also right around my major support area. See all this? See all the buying earlier this year? It held up the price around 2,400 or 24,000 on the Dow. And if the price breaks below 24,000, it's over. These moving averages are all going to cross. This is a daily chart. You have the 200-day moving average crossing my blue equilibrium line. That's like a death cross. The 100-day moving average crossing the 200-day. Let's see if it's on here. Yeah, I mean, they've all crossed. And your moving averages are going to start rolling over, and that's just going to signal a bear market, a recession. And every technical trader should see this. I mean, it's pretty obvious. It's right there. So if the price does not bounce for a few more weeks and months, and it starts dropping like in the next few weeks, maybe even today on the open in a few hours from now, that is very, very bad. That means the end is, it's starting. It's starting, all right? Shit's starting to hit the fan then. And once 24,000 is taken out, I mean, once these major supports are taken out on the Dow and the S&P, it's done. It's the writing's on the wall. Everyone knows that prepare for a bear market. And that'll be the beginning. I don't know how long, how how long, well, how slowly the market will start correcting and crashing. But it's probably, I mean, I don't know. So that's what's scary. And the best investors know they don't know, but they know what to do before it happens, right? Here's another indicator that there's troubling times coming. The dollar has a giant cup and handle on the daily chart. This is the daily chart. Since June of 2017, that's the beginning of this cup, right? The bottom was put in February 2018, and we've been in a bull rally and a bull trend on the dollar all of 2018, and that's because equities started correcting at the beginning of 2017. So this cup and handle should shoot the dollar higher for the intermediate, meaning for the next coming months, maybe a year, but at least into spring and summer of next year. And if the dollar is doing that, that means that the stock market, there's some serious problems. There's stock markets falling, banks going under, you name it, right? Because the dollar is the number one knee-jerk reaction that all institutional hedge funds and banks and pensions, everything, what they do is they go to cash. That's the first thing they do. That's what they were taught to do, right? So that'll give you a nice rally in the dollar. And that's just that. You're not going to go into the euro because the euro is probably going to fall because the banks in Europe are currently failing. And as you can see, there's civil unrest across Europe. The yellow vest movement, it's spreaded from pretty much all of the major European countries that are in the EU, from the UK to Brussels, everywhere. And that's a sign of, the economy. And I made a nice video with great footage. If you haven't watched it, it's a few videos back. You'll see the thumbnail. It's got a picture of Paris. You should watch that if you haven't watched it. Volatility, it's been pretty high for the past few months. And that's another warning sign. So, bonds. I will go more into detail on bonds in my other video. The 10-year has fallen from the 3%, and bonds are a little bit complicated for the average person, and I will have to talk about that. As you can see, there was a nice cup and handle. I talked about this months and months ago, and it played out pretty nicely. I don't trade bonds, but, it was nice to know that was going to happen. Because the bond market does affect equities as well. All right, I will go into depth on my next video when I talk about the yield curve and the Fed. There's a Federal Reserve rate hike coming. Everyone's anticipating it's coming. This will be the most important FOMC meeting like ever this week, Wednesday and Tuesday. Gold, daily chart. I'm going to zoom in here. So, cup and handle, right? I've drawn this many times on gold. For the free chat room, the links are below this video. In the MMG, I've posted this. There was a cup and handle. I expected a breakout. I did trade it to the upside. I was stopped out last week, and I took profits. But that was a nice trade. So cup and handle, and it broke out. Now look at this. There's some buying coming in on gold. And it's been trading around 1260, well, 1256 and 1230 for quite some time. It's a nice range. And if gold can break above this moving average, if gold could get back up to 1250 or get past 1260 conservatively on the daily here, it's going to run. And it's going to make a shot for 1280. Now, that doesn't mean that gold's back in a bull market. it's back in a bull market. I think once gold shoots past 1300. And to be on the safe side, if it gets past 1370, 1380 again, then gold's going into a bull market. And by then, the stock market will probably have fallen 15 to 20% from the all-time high, the S&P and the Dow. So the time window on gold is starting to close. Now, I did say in the spring, early summer, for everyone who's been following me, that the best time to accumulate was back here. And I was doing that then, and I was saying that, right? And I still think that this might have been the bottom for metals, for gold. Now, there could be a knee-jerk reaction when the stock market starts really accelerating to the downside, like starts crashing like it did in 2008 and 7. Everyone might sell their gold and silver stocks, and the futures might sell off as well as a knee-jerk reaction because everyone just goes to cash and they sell everything, including metals, and then the metals will get hit for like a few weeks, maybe a month. I don't know. We'll see. Last time it lasted for like a month and a half, something like that, in 2008, 2009. And that's something to look out for. Now, if that happens, I don't care. I'm not leveraged up on any of my positions, and I don't hold 3x ETFs or 2x ETFs. But I'll just hold it in that scenario, and then I'll triple and double and quadruple down if that happens, if metals get slammed with the stock market when it's falling. That will be the last window of opportunity, if it even happens. This time around, it might not happen because, you know, everyone, 2009, 2008, and 7, it wasn't that long ago. People still remember, all right? And this time around, people are just going to jump on metals, I think. And you'll actually see the dollar and metals possibly rise together. And we'll get a nice breakout. Now, 1300 will act as major resistance, so will 1280, this entire area. And then it'll likely pull back, and that might be another great buying opportunity, and it might be your last. And that will be in the coming few months. Don't worry, guys, it's coming. My research on metals and mining stocks and all that, it's coming. It's coming. My release date is right after New Year's next year, the first day of next year. That's my goal. All right, and I think we'll make it till then. If anything, they manipulate this. All right, they're gonna suppress it for a little bit longer, I believe, at least the first quarter of 2019. But after that, I don't know. I wouldn't. I personally will be starting to really accumulate. Now, this is the spot price or the futures price of on the COMEX for gold. The stocks, the individual stocks and even the ETFs, they don't look like gold itself. They're still like at all-time lows. So that's why you don't have to FOMO. You can relax, all right? FOMO, fear of missing out, for anyone who doesn't know. All right, so let's take a look at the Fang stocks. And then we'll look at Europe for a second. So here's the Fang stocks daily chart. It had a nice bounce here from this major support area, as you can see here. But I mean, the trend is your friend, and the trend is down. You could literally draw a channel right here, and it needs to break this channel to the upside, the Fang stocks. And the Fang stocks you really need to watch is because there's so many ETFs and derivatives of the major Fang stocks that if Fangs go up, it's more than likely going to push the entire market higher. All right? But if the Fangs go down, it's really going to drop the entire stock market as a whole. So I would like to watch in the Fang index as a precursor to the entire S&P and Dow. So we're right there testing the top of the channel today. Today's a very important day. No, today, tomorrow, Tuesday, and Wednesday, this week, extremely important. If the Federal Reserve at the FOMC meeting, right, this Tuesday and Wednesday, if they say something stupid or they screw up or the market doesn't buy it and the market starts tanking, I mean, that's why this week is extremely important. All right. It's gonna let. I mean, we're gonna find out if the Fangs break out or they're gonna tank and possibly break the support in this week or next week by the end of this year. All right. It all depends on the Fed. Literally this week. All right. Here's the Nasdaq E-mini 100 futures. Looks just like the Fangs, right? Not much to say, to be honest. So here's the E-mini light crude oil. They obviously they've already broken below this major support. Right now, I don't know. I wouldn't touch this. Like I've said in the past, oil could drop as people expect a recession because there's just less semis on the highway transporting goods that people buy, because recession means people aren't going to be buying anything anymore because they're broke, they're losing their jobs and whatnot. So oil tends to drop initially. And then I've talked about oil. You can refer back to my few videos. I did a real good analysis on oil. But for right now, I wouldn't do anything. I'd watch if it's going to break out or break down. Because right now it's neutral. It's just sitting on support. This entire area right here is major support. It also depends on the dollar as well. All right, let's take a look at Europe. Let me go back to the European markets. Here's the FTSE. And here's the FTSE for the Eurozone, top 100 companies. Like I've said, it's also on support just like the Fang stocks. Here's the FTSE 100 for the United Kingdom. It's on major support as well. Looks just like the S&P 500. And here's France sitting on support, major support. And the DAX, the German market, sitting on major support. Listen, all of the markets are so intertwined with derivatives, ETFs, debt, buying each other's debt, leveraged up. It's a truly global market. Also, you guys need to understand that the market today is not what it used to be even 30 years ago. Most of these 500 Fortune companies, especially 100 Fortune companies, by market cap, the top 100, top 500, right? These are international corporations. They are internationally based. They're all like McDonald's. You know, if you go to Europe, there's McDonald's everywhere. You go to Japan, China, McDonald's. Go to Australia. It's just like that with Google and Apple and, you know, all these companies, big companies. They are international. So if something bad happens in Europe, it's going to negatively affect the U.S., although I was hoping it might help the U.S. because the U.S. is the last man standing, right? And I think we saw that at the beginning of 2018. Now, what could happen is, as globally stock markets start tanking, it's going to really prop up the U.S. dollar for maybe a few months to a year, maybe a couple years, I don't know. But I think initially it's going to prop up the dollar in the markets in the U.S. The U.S. markets might not tank as much as the European and the Asian, but eventually it will tank, and it'll fall with the rest. It just might prop it up from fully imploding for some time, and this is just speculation. I'm just thinking off the top of my head. But I do know that the dollar will be the first safe haven asset, which is absolutely ridiculous, because if the Fed starts, as soon as the Fed capitulates and says they're going to lower interest rates back down to zero, maybe negative, who knows, and start printing money again, QE, then the dollar is going to instantly drop like an anchor. And that's when your metals go through the roof. And hopefully cryptos will as well, because they're already in the bear market, right? The only way they could go is back up, especially if people start using it for capital flight. What I am worried about the cryptos is you know, draconian like laws coming out, because at the end of the day, the biggest tax collection comes from corporations in the stock market, and they don't want, you know, money to be flooding out of the stock market and the bonds and the bond market into cryptos. That's what I'm thinking. I could be wrong, but I don't think they're gonna want that. You know, the regulators and but yeah, I don't know, guys. Maybe they just can't stop it. Maybe it's too late. They can't pass a law like that. That's what I'm hoping, really. I still think they're not going to be able to stop it. So, all right, I'm off on a tangent. So, well, let's go to the Europe financials. So the banking sector. Now, Deutsche Bank is pretty much gone bust. I will talk more about that in my other videos that I'm going to make right after this one. And the financials. Look at this. This is 2012. The lows of 2012. And this index doesn't go back to doesn't go back. I should have picked a different index, but it doesn't go back to 2009. It doesn't matter, because, you know, in 2011, that's when this index was in deep trouble. That's when Europe first started having some serious financial problems after 2009. And you can see the lows are down here, $13 on this index. Now, in 2016, we saw another major low. It retested these lows, but it made a higher low. And I mean, this is extremely volatile. This would have been fun to trade. And we can see that this index is falling back down to its previous yearly lows. So this is also on major support. If it breaks and falls down there, then, I mean, this could trigger a systemic banking crisis in Europe. So I would watch this index. That's why this week is extremely important. I cannot stress that enough. Let's look at the financials for the S&P 500. Looks just like the S&P 500. It's falling to major support right down here. Same with the Dow. This is the weekly, and this is the weekly on the Vanguard. So this is just the daily on the S&P 500 financials. Let's take a look at this Dow Jones chart. Here's 2009 all the way down here at $113 for this index for the Dow financials, and you can see this massive drop right up here. Look how similar and eerie it looks to 2008 and 2007. Technically, this is a double top, but this did make a higher top for the financials than in 2007 and 8. So if this breaks, like I'm saying, guys, this week, if we fall another couple hundred points on the S&P and the Dow, I mean, it could be all over. It could be, it'll be the beginning of, you'll start seeing banks going under and financials going under. If this drops all the way back down to the beginning of the Trump rally in the end of 2016, beginning of 2017, I mean, that could easily trigger it. Of course, it'll probably bounce a few times and then go lower. But if it falls back down there and we get over a 20% correction on financials, that's enough to trigger banks. There will be no more lending, and that could easily, you know, it'll be the same thing as the bank. You know, the weakest banks will start going under, like Lehman Brothers, like in 2008. That's all it's going to take, because you have to remember they're all leveraged up. And once you get a large enough correction, there's nothing stopping it. I mean, even if the central bank comes out and just starts printing like $10 trillion, something crazy, it might be some short relief for the financials, but that's going to trigger that's what they have to do to save this market. If they do that, I don't care. I mean, my metal stocks are going to the freaking moon. And eventually it won't work, and then it'll probably fall. I think the central banks are planning on trying to do something that Japan did. Essentially, the Central Bank of Japan just started buying stocks, which is ridiculous. That is pretty much socialism, centralized planning at its worst, when your central bank is propping up your entire stock market. I mean, it's already doing it, but when it's openly, like, everyone sees them buying stocks, when they actually admit that they're going to go buy stocks, and they're going to go buy everyone's bags, I mean, then you know your economy is pretty much, it's recession, depression time. Alright, I'll talk more about that in my future videos. So, right now, I'm going to leave you guys with this. This weekend is extremely important, and I'll keep you guys up to date. Maybe I'll live stream the hearing, the chairman talking, and I'll provide some commentary. I'll cut through the BS and what they're saying, and I think this FOMC meeting will be one of the most important ones of our lifetimes, to be honest. Alright, guys? So stand by, click like, and watch for new videos I'm going to upload today and tomorrow this week. And it's going to be an interesting week, guys. Let's hope we don't get a Black Monday this morning in the next 3 hours. Alright, guys? Until next time. Thumbs up, comment, put comments in the comment section, and share my videos. I'd appreciate it. And check out the links below. We have free chat rooms where we share ideas and we help each other out. Until next time.